Have you ever heard financial terms or concepts and thought, this doesn't make sense? Well, you're in luck. Welcome to Make It Make Sense, the podcast powered by Acclaim Federal Credit Union, where we break down the world of financial literacy. At Acclaim, our goal is to connect you to financial wellness, and this podcast is here to lead the way. Whether you're just starting out or looking to sharpen your financial skills, we've got you covered. Let's make it make sense together. Here's your host, Christy Smith.
Welcome to another episode of Make It Make Sense, where we attempt to make sense of financial concepts. We took the summer off, but we're back and we have some really exciting episodes throughout the rest of the year. Today, we have Jennifer Kettlewell. Jennifer is a mortgage loan officer with myCUmortgage. She has over 20 plus years of experience in the mortgage world. And when I was researching what types of topics that I wanted to talk about on throughout the rest of the year, my daughter said, you should do something on mortgages, Mom. She said it is really complicated to get straight answers on how to apply for a mortgage, what you need. And my daughter's smarter than I am. So I said, that's a really good idea. So then I thought about Jennifer. She is a mortgage guru, and I am very excited about what you're going to learn from Jennifer today. So without further ado, Jennifer, welcome to our podcast. I'm very excited. And in my intro, I told our listeners that you are the mortgage guru. So we're really excited about the education that you're going to give our listeners. Before the podcast began, I was talking to Jennifer about my daughter, and this was actually her idea. She said, Mom, she's a recent graduate. She's, new in the workforce, and she was trying to decide whether she wanted to buy a house or if she wanted to lease. And she was just looking at those options. And she said, it's really hard to get good information, and it's a lot of information, and sometimes some of it's hard to understand. She said, you should do a podcast episode on mortgages. And I thought, that's a really good idea. Our kids can teach us a whole lot. And so I could not think of a better person than Jennifer. Jennifer works for myCUmortgage, and they handle all of our mortgage needs, and she has been a fantastic partner. So again, thank you, Jennifer. So we will dive right in. Can you break down the different types of mortgages in simple terms?
Sure. So the easiest way that I explain this really is there's two types. At the end of the day, there's really only two types. You're either going to get a conventional mortgage or you're going to get a government-backed mortgage.
Okay.
So conventional mortgages typically are built for people with better credit, better income, better assets. They're just a low risk of default, and they fit within normal mortgage guidelines. When you do not conform to those guidelines, then you will look at government-backed options. Maybe your credit's not so great. Maybe your debt to income's a little higher. So the government stepped up as a way of getting more people into homes by offering government-backed mortgages. And those are USDA, FHA, and VA.
Okay, perfect. No, that's awesome. Thank you. How does credit score impact mortgages? I know that's a big thing with being able to qualify. And you just mentioned there's certain mortgages that you can't qualify for if you don't have a certain credit score. So let's talk a little bit about credit in mortgages.
Credit is absolutely everything in a mortgage. So for conventional, you're really going to need to be about 680 or above. The lower credit scores will typically go government. Credit scores for conventional mortgages determine what rate you're going to get. So better credit scores get better rates.
Yeah, so important. So I am, a college graduate and I have limited credit. What should I do to help build that credit score that's going to look better for me to fit into either type of mortgage product?
That is a really, really good question. So what I would say is when you're a senior in high school or maybe early in your college career, check with your parents about getting added to their credit cards as an authorized user. But going into maybe your senior year, you're going to need to start establishing credit of your own. So it's a great opportunity to get a credit card, and credit cards typically can score you the best. What I highly recommend is getting a credit card. You are only going to use that credit card to buy gas or maybe groceries, and then get in the good habit of paying it off every month. Like I tell my sons, if you can't afford to pay it off at the end of the month, you don't buy it. It's for things that you need and not things you want.
No, that's really good advice, and that is something that we did with both my children. That was kind of their gas card, and that's how they got gas, and we know they need gas, and so they would pay it off every month, and it did help build credit. I tell them all the time, "Look, I set you up great. Know what you do from this point forward's on you." But
I
they're
did the same thing. Yes, I added my boys to my credit cards when they were in high school. And so my son is sitting in one of his econ classes talking about credit, and the teacher's like, "Does anybody know what their score is?" And he was able to raise his hand and be like, "Yes, I have a perfect credit score." And he did.
Oh, that's fantastic. That's wonderful. But for those who don't have that, so not everyone has that luxury to have someone who can
Yep.
add them on. The credit card option is still out there for them to go ahead and start building, like you said, when you become 18. And maybe look for something that gives you a cashback option. I know at Acclaim we offer a credit card with a cashback option. So, and something very small. And like you said, small enough that you can pay it off every month is really great. So, anything more you want to add to that?
Recommend two things. So there's going to be two types of loans. So what we want to see as a mortgage lender is we want to see at least a couple trade lines that you've had at least a year. So the types of trade lines can include a revolving debt. That's going to be a credit card, or you can get an installment loan. Installment loans have a balance that you are going to pay back. But when you pay back that loan in full, then that stops reporting. So maybe to establish credit cards are definitely number one. But maybe go to your credit union, Acclaim, and
Mhm.
get a small installment loan. I tell people stick that installment loan in a savings account, pay back the loan with that money. So it should be pretty easy to get a credit card and an installment loan to begin the journey of establishing credit.
Yeah, that's great. That's wonderful. So, how much should someone realistically expect to have for a down payment? And I know that's going to depend on what you're purchasing. So, what type of home are you purchasing? But I guess percentage wise, do you have a percentage of what someone should have saved?
Yes. So I'm hoping that my college people have a chance to move back home and save money, because having assets is so important. So conventional mortgages for first-time home buyers, they do have a couple programs that instead of putting a 5% down payment, you can have a 3% down payment. FHA is going to be 3.5. USDA does not have a down payment, but there are a lot of extra strings with that. Like your debt to income's a lot stricter, and you have to live in a qualifying area. So most first-time home buyers will pick a conventional or FHA loan typically.
Okay. Okay. Yeah, that's good to know. Beyond the down payment, though, there are also upfront costs that you have to budget for. What do you find as some of those unexpected costs that, when your borrowers look at you and they're like, what? I didn't expect that.
Yeah, absolutely. Okay, so getting into detail, there are really four things that a buyer is going to be responsible for. Now, in a contract negotiation, you can have the sellers pay closing costs, and I highly recommend that. But the four things that buyers are responsible for and probably are not really prepared for is the first thing is the down payment. And that's a little bit more of the obvious. The second one is mortgage closing costs. And that includes lender, title, appraisal, recording, like all the good stuff. And I would expect that to be at least about $45,000 to $6,000. The third would be escrows. So escrows are required on a mortgage unless you're putting down 20%. So escrows are kind of like a forced savings account, really, where we're going to hold so much of your money to start your taxes and your insurance. And again, I like to tell people to think of that as a forced savings account. It's not a cost, it's just your money that we're holding for this escrow account. And then the fourth thing is called prepaids. Prepaids can include two things. One is your homeowner's insurance premium for 1 year and odd days of interest. Odd days of interest is just from the moment you close your loan to the end of the month. That's usually kind of a nominal amount. So the four things again are down payment, closing cost, escrows, and prepaids.
Yeah, no, that's really good. And you're right. I remember getting my first home a very long time ago, and it was like, oh, wow. I didn't expect some of those other things. We could also talk about PMI. If That's another thing that some people don't understand, that if there's not a percentage of the home, you're going to have to pay sometimes private mortgage insurance, which adds to that payment too. And I don't know, do you see that in most mortgages?
In almost every mortgage. So PMI for conventional is on every single loan. Unless you have a 20% down payment. So
Yes.
sometimes I'll still hear the old myth that you have to have a 20% down payment, and that's not true. But to avoid PMI, then it's 20%. Now, the importance on a conventional mortgage of credit score is rate, but it's also private mortgage insurance. So the higher your credit score, the less of a risk of default you are. And also, the less your private mortgage insurance is going to cost. So, somebody with like a 740 credit score is going to have a lower PMI monthly amount than somebody with like maybe a 650.
Yes.
On all government backed loans, you'll always have mortgage insurance.
Okay. Yeah, that's good to know. That's really good information. So, what income requirements do lenders usually require? I know sometimes what we want and what we can get are often two different things, and I've actually seen that in my life. I want more than
Yes.
probably afford. So what would be your advice there?
So, debt to income changes with all of the mortgage types. Conventional is 45. FHA can go to 55. USDA is a strict 41. And VA is definitely more practical of all the mortgages in that it's based on a residual income, but most college grads are probably not going to get a VA loan. So, what I recommend is when you're looking for your house, think about all of the debts that are going to report to your credit report. So, your credit card monthly payment or your installment monthly payment. You're going to take that number, add it up, and divide that by your gross income. And that's your debt to income. Now, for mortgages, it's just a hair more complicated, and we're going to take your proposed mortgage payment plus your debts and divide that by your gross income.
Okay. Well, what if I have student loans and they are
Great question.
deferred? And so how are they going to handle that?
Great question. So we defer to the credit report. If the credit report shows a monthly payment on all mortgages, that's the payment that has to be used. For conventional, if there's no payment on your credit report because it's deferred, then we're going to use 1% of your balance as your payment. Or if you have a lot of student loans, like some of us do, then we're going to use an amortization schedule. Government-backed loans are 0.5% of your balance, and that's going to be your payment.
Okay. Yeah. What are some of the, I'm sorry, can you give me some examples of property taxes? So they don't always stay the same. And so what we find is I'm not sure what county you live in, but your property taxes can go up and
Mhm.
your homeowner's insurance can go up, which then in turn can affect your payment. And that's another thing that I don't know that everyone understands, but you know, what percentage would you give that you should allocate for that on a yearly basis?
So a couple tools. One is almost all property taxes are online. Also, if you go to tools like realtor.com, they usually have an estimated tax amount, but that's so true. So I will get calls to this day where people are like, oh my gosh, my mortgage lender is increasing my payment. And that always tells me that either their taxes went up or their insurance went up or both. So, a great way to be prepared is look those up. Like, as you're looking for houses, we, the lender, are going to tell you about what you can expect with taxes
Mhm.
and insurance.
Yeah. I, I w- I know here recently, and then when I say recently, within the last year or so, I've seen a couple of counties where they went in and just did some reevaluations, and there were a lot of upset citizens about that. And I know it does have a direct impact on, your mortgage payment, which then can make it harder. So, I mean, I understand, but if you're prepared for it, like you said, it does make it a little bit more palatable.
I agree with you. There is a funny meme about what your tax assessor sees, what the county sees, your appraiser sees, and what you see. And definitely my county thinks that we're rich.
Yeah,
So,
yes,
yes,
definitely.
property taxes do go up. And so it is important to, you know, that saying, don't be house poor. So maybe you don't go to the top of your debt to income ratios.
Yeah. No, I think it's really important to make sure that you're budgeting for maintenance too. So now
Yes.
you're a homeowner and unfortunately things break and
Oh,
things
yeah.
happen and the tree falls, or whatever that may be, and you're responsible for it now. And those things can get really expensive. So also making sure that you're budgeting for some sort of maintenance on your home is very important.
Yeah, the most important thing if I could give to anybody is to save money. And I know how simple that sounds, but it does take some discipline to save money. But you're right, you're going to need a down payment. Things are going to break in your house. You're going to need furniture. Like, set a budget. And in that budget, allow for so much of your money to be put in a savings account.
Yes, pay yourself first. I think that is so
Yes,
important, and making sure that I wanna do it too. I want what I want, but I don't always need to do that. So, I know it's important for us to budget and then making sure that we stick to that budget, especially because it will pay off in the long run, and especially I see that with homeownership. There's such a pride with people who buy their first home. You just see the excitement and how happy they are, and
I love
it
it. Yes,
yeah. And so, I really do want that for this next generation or anyone who's a first you don't even have to be a college
agreed.
graduate, but anyone who is a first-time home buyer. And I think now that the confidence in that has gone really low. And I can tell you that for sure because the younger employees that work at a claim, they say, "Oh, I'm never gonna be able to buy a house."
Yeah, I hear that.
And, I hear that, and it's really sad to me because they're not they mean it. It's not that they're not trying to save or they're not responsible.
Agreed.
It's just they don't think it's attainable for them. And, that does make me sad, and I hope that we as a country can do something to help them not feel that way and to get that joy of homeownership.
There is a little bit of hope now that rates are kind of stabilizing. I've read that there's more houses on the market than there have been in the last 5 years. I know everybody wants cheap interest rates, and me too. But one of the things with having really cheap low rates is it drives up the price of houses. Now that the rates have gone up and they're trickling down a little bit, it is helping to stabilize property values so people can afford a house.
I'm seeing that in my neighborhood as well. And they used to, I mean, you would they put it on the market and it would be, I mean,
Yes.
it was gone. And now, we have several that are staying on the market for longer than I would have thought. And so I can kind of see that softening as well. And you probably see different areas. I don't know if you're just in North
Yes.
Carolina, but that is a good sign for someone who, maybe thinks I never can own a home, and
Right.
maybe it's coming back around. So we can hope. What is the biggest mistake you see young buyers make, and how can they avoid it?
Getting into debt early. Like I will, cars. Cars to me are probably the biggest mistake, right? Like I just did a mortgage application for a sweet lady and she bought a Mercedes and she has a $900 car payment. And I'm like, you bought a car that's not going to appreciate and the payment is 900. Like that's half of a mortgage payment. So that's probably the biggest mistake that I see is financing cars as opposed to buying the house or buying the car and then looking at buying the house. So maybe house comes first. And then I know you need to get to work, but maybe buy
Right.
that junk car at first. Um, so I would say that's probably mistake number one. Mistake number two is not taking care of your credit.
Yeah. No, I agree with both of those things. We've kind of seen that too, and it is very important. And my daughter has her CRV that she's had forever, and so it is. We maintenance it well, and it has really been a good car. And so she really doesn't want to give it up, but she knows that it's probably time.
Oh, yeah, I have
But
a little Honda Civic that I'm probably
mm,
going to drive to the retirement home with me, but it's paid off.
there you go. That's exactly right. So and we'll finish this up with this. So I'm coming to you as a 25-year-old, and I say, Jennifer, walk me through this process. What's it going to look like for me?
Okay, so the first thing is that I'm going to take a mortgage application. The second thing I'm going to do is pull your credit because credit is absolutely everything in a mortgage. And then we're going to go over loan amounts, debt to income, rates, payments, because the credit score will let us know everything we need to know so I can direct you on what type of mortgage you're going to qualify for, how much you're going to qualify for, and the very important piece, which is what is my payment going to be?
Yeah. Yeah. Very important. How, so if you wanted to get a pre-approval, how how long do they last? And, should you really, I guess you should really be interested in something. I don't know. I'm asking the question. When is the right time to do that?
Sure. So if you're thinking to yourself, is it my time to buy a house? That's the great time to get pre qualified.
Okay.
And one small thing. So I know that we've said pre qualification and pre approval.
Okay.
So we will do initially a pre qualification, which is what you tell me your income and assets are. A pre approval is when we have documented your income and assets. So a pre qualification takes about 20 minutes and it's good for 4 months.
Okay. Yeah, no, that's great information. Thank you for that. And you've given us so much today. I'm just so excited. I love how you made mortgages make sense, and mortgages made simple. So I appreciate that. What I do is I ask my guests. I took the summer off, and So now we're getting back in the swing of things with our podcast. But I always ask my guests, who is the most influential person in your life as far as finances?
I don't have a particular person. I think that I get my financial information that I value the most in pieces. Like one piece that I have driven home to my children is poor people buy things, middle class people buy liabilities, and rich people buy assets. So I'm always hammering home to them about the importance of saving money, not buying things, and limiting liabilities.
Mm. Those liabilities get us in trouble.
They do. That keeping up with the Joneses sometimes. So live simply is really, I think, the best advice. Like, I can't think of the financial guy that talks about living debt free. And I do like that, but you do need credit. It's so important when you go to buy things.
No, I agree. When I hear others say, pay cash for everything, and I'm like,
No,
you are going to need debt. Is not always bad as long as you can, manage it well. It's not always bad, and it's necessary for even getting like car insurance and things like that.
Yes.
Getting better rates for that. So, yeah, debt is definitely necessary, but you just need to learn how to
manage it and not overdo it. Yes.
Exactly. Well, thank you so much. I appreciate your time, and I can't wait for our viewers to hear all the tips and tricks and the information that you've given them today. And I thank you so much.
Oh, my pleasure. Thank you so much for having me.
Well, I hope you have a wonderful day.
Thanks. You too.
Okay. Bye-bye. It has been another great episode of Make It Make Sense. Podcast production services provided our Pro Podcast Solutions. That is a mouthful, but we are so thankful for them. Until we meet again, have a great day.
Thank you for listening. Please visit us at acclaimfcu.org for more valuable resources. Remember to click the follow or subscribe button to make sure you don't miss future episodes.